Hey, this is Sasha. If you have a trading or investing stock question, feel free to reach out at our website at tradersfly.com and you can ask one by voice or you could always submit one in. Today's question is all about hedging. We're going to talk a little bit more about hedging because it seems to be that the concept is misunderstood. So stay tuned and stick around. All right, so I think one of the first things you need to understand when it comes to hedging is what is hedging. And hedging is really a way to protect your portfolio in case of a downturn or move. Think of it like insurance, okay? If you go ahead and have a car and you're driving the car and you want it insured in case you get in a wreck so you don't have to pay for the full car, then you get insurance. And that's what you want to do with hedging. Now, some people say, hey, well, why don't I just go ahead, sell the stock if I think a downturn is coming? But there's a lot of issues that go with that. So let's go kind of on screen here. There's a question that came in from Michael that said, hey, a little confused. If hedging is supposed to limit your risk, okay, but limits your profit simultaneously, why would that be a better strategy than simply selling out of your position, buy back after earnings? Okay, so that's really, or after the market news and the time frame. So that was kind of the main question right there. And I want to share with you this big concept behind this. Okay, so if we zoom out a little bit and kind of take a look on paper, there's more consequences that you have to take into account, because when I'm looking into buying a position, so I'm invested in a stock and I think it's going to do something like this, but I don't know when this downturn is coming or when something worse is coming. So I need to protect it. So there's different levels you can go ahead and protect it at. Well, if I go ahead and this time frame is, let's say, 12 months, if I sell out of these time frames, now depending on your tax consequences, depending on the tax laws, things change all the time with this government thing. If you're in a short term profit, well, you could be paying 35%. Whereas if you're in a long-term profit, you might be, 12%. Let's just, for conversation's sake, right? So having a long-term capital gain is a lot better than a short-term. So what do you do instead? Well, you protect your position. You insure it. This is what hedging is for. And you might hedge, who knows? Everybody's at different time frames. One person might hedge, 3 times a year. Other person may hedge all the time. 12 times a year, and I'm just saying 12 times based on months, so this person number 2. Another person may hedge, maybe person number 3 may hedge 3 times per 10 years. They're just really worried about the big down moves. So everybody's at different points depending on how much risk you want to take on, depending on how large the position is, depending on how much protection you want. And you can hedge and protect in a smaller amount. Really, everybody's a little bit different. So if we look here on screen, and I go over here, you can see that this position on Microsoft that I have, I'm netting about $11,000 profit. So you can see right there, there's Microsoft, and here you go. Here's the position, $11,000, 267 for today. So this one's got about 300 shares in it. Okay, and if we go ahead and take a look at this position, well, let's just say I've held this for about 2 years. Now, if I go ahead and I want to continue holding this, I don't want to, take tax consequences. Then what I could do is go ahead and protect it and say, hey, well, I think maybe in the next month or 2, we might have some major problems. And what I can do is I could say, okay, well, why don't I get a put? I buy a single put, and I could hedge it. And this is what I'll do. And for me, I have 300 shares. So ultimately, to protect it fully, I want 3 contracts because each contract is 100 shares. So it controls 100 shares. So what that does is when that stock pulls back, if it gets to $130 a share, I'm flat. I won't continue to lose money, which means I will still be profitable, not $11,000 and some dollars, but I'll still be profitable $8,000. And that's if we have a major catastrophe. If the world blows up, I'm still profitable $8,000. Now I could protect it a little bit more. I could say, hey, 135, and now I'm profitable $9,000, but it costs me to have these contracts. So how much does it cost me to have these put protections? Well, it cost me about $1,290, as you can see over here on this left side. It cost me $1,290 to have that protection. Now, is that worth it to, because you might lose the full protection amount? Maybe, maybe not. It just depends how fast the market's moving. Because if you do this every single month, of course it's going to cost you. Now, what I can do also is protect only about 100 of those shares if I want. And what that does is it just slows down kind of my losses. So you could see this line, the steepness of it is kind of right there. And if I go ahead and just protect 100 of those shares, it kind of slows down that problem. So you could just do that, or you could do, 2 of those. And you can see it goes from the steepness of kind of this line, it transforms it to more something manageable. So anyways, that's what you need to really understand and be aware of when it comes to hedging. You could do it in other ways. There's different ways to hedge. You could sell part of your position, but again, you're taking a capital gains when you're doing that. So understand that you do have tax consequences on the maybe a shorter term gain, or now all of a sudden that's considered a profitable position. So for everybody, they manage it a little bit different. This is one way to hedge. There's many other ways to hedge. You could actually go ahead and, instead of doing it on the SPY, you could actually or on the Microsoft, I could just actually short. So here's another one. I could just sell, let's just say, 20 shares of SPY. So that's another way to do it. So now when I look at my total portfolio, and again, we'll get rid of Amazon, Facebook, and some of these other portfolio areas. And when I just have my Microsoft and my SPY on a portfolio beta weighted, you can see it just transformed my curve a little bit. And again, you could short maybe a little bit more shares, because I have obviously 300 Microsoft shares, so it might take a little bit more. But what you're doing is right there, you can rotate that curvature and that graph a little bit, so that way the steepness as stocks go down is not as bad. And a third way, you could also get an inverse ETF. So for example, like FAZ, this is the ETF shares of financial bears. You could get TZA. Here's another one, small cap bear ETF. So anything like this, or a short, a short ETF 3 times leverage, you could do that, but that's usually not the wisest approach, because you're not going to hold that for a month or two. So anyways, those are a couple of ideas for you and some things to think about, but this is really why you kind of hedge a position. And the whole point behind it is really to avoid either tax consequences, or maybe you hold that position, you just protect yourself for, let's say, a Brexit, a presidential election, anything where you may expect major movement, you might get that protection for a couple weeks, a couple days, and you can get out of it a little bit later, and maybe you can get part of it back, because if all of the time premium isn't used, if you're doing options, you should be fine and okay. If you're shorting, again, maybe it goes against you, you lose a little bit, but not as much, because your other position is still a little bit stronger. So the whole point is really to cushion yourself for a down move. Anyways, thank you for joining me. I hope you found this video helpful. Don't forget, if you got a question, reach out at our website at tradersfly.com, and you can submit one by voice, or of course, hit the face icon here, and then you can go ahead and subscribe to our YouTube channel as well. Thank you so much, and remember, do what you love, contribute to other people, but most importantly, live life abundantly. I'll see you next time.